your portfolio, looking at it, is over $2 million large. You're making $26,000 a month off of this. This is all covered call ETFs.
It's a pretty, decent sized portfolio. It's basically everything I have. So,
It's not that complicated though. It's not that complicated. I'm going to list them, but you have HYLD, and tell me if this is the bulk of it. HYLD, this is going to be on screen. USCL, QQCL, HHIS, MSTE. That's five. That's a five. These are all ETFs. They're all covered call ETFs, right? For the most part.
Yes, they are. That's always going to be my bread and butter. So you're probably looking at April. The May one is actually, the update's actually coming out in a few days. There's a couple of extra ones in there relating to Bitcoin. I could give you the stock symbols if you want. They're small positions, but it's those are my core positions for sure. Those are they're big, massive positions. Another two Bitcoin related covered call ETFs that I added is HBIX and HBTE. They're both from Harvest. They're both covered call ETFs. They both have 25% leverage. And obviously, as you could see from my portfolio, that is actually my favorite format of funds to own. Covered calls and 25% leverage. For me, that's like the holy grail of income investing. And we could talk a little bit about why I feel that way later on. The question, it's your podcast, so I'm here to answer whatever you want. But the ones you mentioned, yes, are my core positions. I did add two other ones, which will complement the MSTE, the MicroStrategy. And those three together are kind of going to be my Bitcoin exposures, if you will.
Okay, let's figure out how to tackle this. First, let's just go through each one by one. But then I want to come back to how are you growing? I'm going to come back to this. Just know, how are you growing your portfolio? Because these are covered calls. So I always say, focus on capital gains when you're an investor. That's how your portfolio grows. Covered calls is better for short-term income, but you're not an old guy. You're a young guy. You're trying to get income now. But I checked your portfolio. Your portfolio is getting larger. It's not getting small. There's a lot of questions I have about that. I think just table that for a bit. Let's talk about it. But let's just tell people a little bit about each ETF here, because I own HYLD, you own HYLD. Why did you pick HYLD? Because you have a position in it. It's 12.56% of your portfolio as of April.
Yeah. So the way I look at my portfolio, especially recently, because my portfolio throughout the years and people who have been watching my channel that's actually just past 5 years now. I still can't believe it. But my portfolio has evolved in the last 5 years as well, because a lot of these funds, as you know, did not exist even 3 years ago. Right. So being a covered call or an income investor, when I started, was a lot harder. There weren't many covered call ETFs out there. There certainly weren't leveraged ones. It was more of a very niche and lesser known way of investing. It still is, but it's getting a lot more mainstream. And I would say, the covered call ETF space has really blown up, especially in Canada. The US was a little late to the game, but it's blowing up there too. But in Canada, you have a lot of big players now, or a lot of smaller players that have gotten much bigger. But 5 years ago, the biggest player by far was BMO in terms of covered call ETFs assets. I think they're still number one, but you have guys like Hamilton, and you have Harvest, and you have Global X Canada now that rebranded, used to be Horizons. Brompton's in the game. You have Evolve ETF. So there's a couple of other little ones as well, but those are, you got more players now, more competition in terms of covered call ETFs in Canada, which is great. So yeah, HYLD for me, the way I look at it is the S&P 500 to make things simple. So personally, throughout the years of investing experience, I've pretty much come to the realization, like many investors do after a while, that start with, picking stocks and looking for stocks and whatever. You're not going to beat the S&P 500. Sorry. There's a 99% chance you're not going to do it. So HYLD is actually, if you look at what it's, you go to Hamilton's webpage, it says they're trying to follow or have a similar asset mix to the S&P 500. Right. So HYLD is a Canadian hedge to the Canadian dollar. It's a Canadian listed ETF. You're buying it in Canadian dollars. You're getting your dividend in Canadian dollars. They also have HYLD.U, which is still listed on the Canadian market, but you buy it in USD. That one is not hedged. So essentially, it's kind of like, it's basically an S&P 500 ETF hedged. to the Canadian dollar. So in my opinion, the best ETF to always compare it to would be the Vanguard, the Canadian listed Vanguard S&P 500 hedged to the Canadian dollar, which is VSP. VFV is the more bigger popular one. That's the non-hedged one. So VFV non-hedged, VSP hedged the Canadian dollar. So HYLD is kind of like a covered call income equivalent, or with very similar assets, very similar stocks to VSP or the S&P 500.
You can hold that in your TFSA, correct?
Anywhere. This is a regular ETF. You could hold that anywhere. Yeah.
I was watching one of your videos and recent video, and your users are saying, your viewers were saying, but the 15% withholding tax. And your response was, wait, no, that doesn't apply, because it's 15% withholding tax on US dividends, but it's capital appreciation you're typically getting paid out on, right? The premiums on the covered call, which is a capital gains.
So a couple of things there. So there is no 15% withholding tax if the ETF is listed in Canada, right? So this is only coming from US listed stocks or ETFs. So you got to have something like JP Morgan stock, or even Apple and Microsoft have Nvidia. They have tiny dividends. And the 15% withholding tax, first of all, is only on dividends. And in Canada, covered call income, which is the majority of what these covered call ETFs generate, in Canada, option premium, covered call premium, classified as capital gains, not dividends. So as long as you have your ETFs listed in Canada, you don't have to worry about that 15% withholding tax. Now, there is a caveat to that. If the ETF itself holds some US dividend stocks, they have to pay 15% withholding tax on that. But it's so small, because the S&P 500, if you just look at the yield itself, it's maybe about 1%. Because there's not many dividend stocks in the S&P 500. Well, there are quite a few, but the dividends are really small. Yeah. So it's possible that Hamilton or Harvest or BMO does pay 15% withholding tax, but it's handled within the ETF. It's transparent to you. You don't see that as an investor. You actually have to go on their website, look at the 2024 breakdown of the distributions, and you'll see a column that's typically called foreign income tax paid. And if you see something there, that means that they paid that much in withholding tax. But it's typically always zero or very little.
All right, that's good to know. For me, I don't hold HYLD in my TFSA. I just have it in a non-registered account. It's not part of my TFSA. Let's move on to Global X Enhanced S&P 500 covered call ETF. That's USCL. And really quick, I've noticed over 80% of viewers who watch aren't subscribed. An easy way to support the channel is by hitting that subscribe button. And I personally commit to continue providing quality educational content with each video. And let's see what you have here. So that's as of April. Everything, guys, I'm saying is as of April. His latest one's coming out in a few days, so check his channel to download that. This is weighted at 18.4%. It's got a yield of 12.77%. And by the way, let me just go back here quickly. He's making this. I love this. You're making off of HYLD $2,178 a month. The one we just mentioned, USCL, you're making basically $3,200 a month. Talk to me about why you add that in, because now I'm not too familiar with Global X Enhanced. I'm just going, you have two of the same S&P 500 ETFs
exactly.
covered.
That's a good question. I still get that question all the time. So much so that I made a video recently called HYLD versus USCL.
Okay.
So there's a few differences between the two. USCL is literally the S&P 500. Like it literally holds the S&P 500. It writes in covered calls, but it writes index calls. So SPX call options. That's the difference, number one, between HYLD and USCL. HYLD, if you look what's inside on their website, it's a combination of multiple Hamilton ETFs. There's the two biggest ones are SMAX and QMAX. SMAX is kind of like a concentrated S&P 500. QMAX is like 15 technology stocks. So they're actually holding the stocks themselves, the individual stocks, the Apple, Microsoft, blah, 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 blah. And it's it's kind of like more or less it translates into an S&P 500. It kind of follows what it does. But USCL is literally the S&P 500 index, and that's the first difference. The second difference is that USCL is not hedged to the Canadian dollar. HYLD is. So in essence, if the Canadian dollar gets weaker and versus the US dollar, so the US dollar is getting stronger, which it has been doing in the last 6 to 12 months, that's going to benefit USCL and hurt HYLD a little bit because you're holding them in Canadian dollars, both of them, but they're investing in US listed assets. So there's some currency implications there. So that's exactly why I have both of them. I like both of them. I like both Global X and Hamilton. I like the strategies. They're very, very similar. The management fee is the same. They're writing covered calls on it. They both have 25% leverage. But HYLD, I personally will always compare to VSP, and USCL, I will always compare to VFV because it's not hedged to the Canadian dollar. Those are really the main differences. But for me, the way I look at it, HYLD and USCL are like a unit. They're like twin brothers or twin sisters, and together the combination for me makes up my S&P 500 exposure.
It completes it balances it out. It completes it, right?
So you could say it balances the currency risk out. So if the Canadian dollar gets weaker or stronger, one's going to benefit, the other one's not. It kind of balances out. So I don't have an equal weight between the two, but
are you trying to equal it out?
It might be getting there, but they're both, for me, they're both S&P 500 exposures.
Is it just weighted to the one that you started investing in first has more allocation? Like you have 300,000 in global, but Global X is newer though.
It's Global X is newer, but the S&P 500 isn't new. So to me, that doesn't matter. As long as you understand the strategy, you're good. The thing is, and we'll probably talk about this, I'm a Canadian non-resident for tax purposes. So my tax situation, completely different from yours, right? So the way it works is if you look at the breakdown of USCL and look at the breakdown of HYLD for 2024, USCL only has capital gains in ROC, which is exactly what I want as a non-resident in my cash account. So I might as well talk about this now because your audience might be scratching their head. When you're a Canadian non-resident, you're not declaring taxes in Canada anymore, right? I'm a resident of Panama. If I hold Canadian listed ETFs in my cash account, I'm subject to the universal Canadian withholding tax rate, which is actually 25%. So every month I get my HYLD, USCL, everything in my cash account. I get those dividends automatically. 25% is withheld from my broker Questrade. That's a lot, yes, but the following year, the portion that was deemed to be capital gains or ROC, I get it refunded. So I have a big motivation to only put things that give me capital gains or ROC in my cash account. So this is why I have a little bit more in USCL, because HYLD has a little bit of dividend stocks in there. It has some bonds in there. So there's a small portion, maybe 10%. It's not that much. That's going to be foreign income or other income. So on that portion, I don't get refunded. So this is why I actually have a lot of HYLD in my TFSAs, and I have more USCL in my cash account. So I'm trying to maximize as much as I could every dollar for tax savings. That's really why the percentage is that way. But for me, they're both kind of, in terms of assets, they're very similar, if not the same.
That why you moved to Panama for the tax benefits?
It's definitely one of the reasons. I'm not gonna lie. I'm not gonna lie. But everything that happened in our lives, to be honest, it happened because of this style of investing and becoming financially independent. If we didn't accomplish that, who knows where we would be, and you know what I mean? So once we got our financial independence because of this style of investing, and we were able to quit our jobs and live comfortably off our income, it just dawned on us fairly quickly, why are we still in Canada? The weather is cold. The taxes are high. So we started looking at other options, and Panama came up really quickly on our radar because we followed another Canadian couple who did the same thing, Stephen James and Tatiana James. Their channel is Project. Well, they both have channels now. They had like Amazon businesses. They're really rich. Okay, they're like 100 millionaires or whatever. I
Yeah.
think they go back to Vancouver once in a while. But we followed them, and they started. Their plan was to go to Hawaii or California, and then they discovered Panama and how much bang for your buck is, and they really liked the country, and they started talking about it, the taxes. So we looked into it and said, hey, we're not working. Let's just spend the winter there because we're Italian, so we don't do well in cold weather. Okay,
Yeah, yeah.
we spent 3.5 months in Panama the winter. We fell in love with it, and the rest is history.
I want to come back to this. I have a lot of questions about that. So anyone watching, just know we're going to come back to this. I want to talk to you about, after we work through this list,
Sure.
that process of you guys were working, you came across this. What was that process of building your portfolio, getting that financial independence?
Not a problem. I'll do my best.
Maybe we can come out with a roadmap for everyone watching. Let's just dive into that, but let's just hammer through this list here so then everyone has it. But then what's one of this list if we don't know how to get that financial independence? So let's talk about that too. So the next one is Global X Enhanced NASDAQ 100 covered call ETF QQCL. So now you're just tracking the NASDAQ 100, same thing,
Exactly.
covered calls.
It's essentially a mirror image of USCL in terms of strategy and everything, covered calls, 25% leverage, except it's on the NASDAQ 100 index.
You're weighted
Global
heavy on
X
this.
really has pretty much all the indexes with covered calls, all the indexes with covered calls and leverage. They even have growth indexes, and the growth indexes with 25% leverage. So Global X really, my opinion, has nailed it out of the park. If you're an index investor, you like indexes, whether it's growth, whether it's growth with leverage, whether it's covered calls, whether it's covered calls with leverage, Global X has all of them. They recently completed their suite, but yeah, QQCL is basically you're investing in the NASDAQ 100 index. They're writing covered calls on the index, or NDX calls. And I recently did a 30-minute Q&A with the head of investments there to talk about this. They invited me to Toronto to their office. So if you guys want to check out that video on my channel, there's a recent Q&A with him. But they're writing, just like USCL, they're writing index calls on the option, on the index, on the NASDAQ 100. So QQCL has about 15.5% yield because it's a little bit more volatile than the S&P 500. The NASDAQ 100 is. There's a lot of overlap between the two, but yeah, that's the next one on the list.
This is pretty balanced. I'm looking through it because if you add up HYLD and USCL, that's 30% of your portfolio. QQCL, which is NASDAQ, 30%. So you're kind of sticking to that. So that comes out to, for QQCL, guys, remember, download this PDF so you can see what I'm seeing. That comes out to $5,665 a month. So you're already at over 10 grand a month. And 30%, 30%. So this is, now looking at this is like you're safe, your Molson Canadian of covered calls. It's like, it's going to provide for you. It's like it's a good beer. It's stable. You have these 3 ETFs, S&P 500, NASDAQ 100. But now we get into HHIS, which is 14 stocks only. It's the Harvest Diversified High Income Shares. I'm not too familiar with this
15.
one.
It's Apple's going to be added in it soon. So just before we move on to HHIS, yeah. So HYLD, USCL, QQCL, to me, it's like owning the risk. So whenever you put covered calls on something, you're actually lowering your risk or your volatility a little bit. That's what covered calls do. But then these funds add 25% leverage, which increases the risk a little bit. So it kind of balances each other out. So I just want to make your audience understand. And this is a question I get all the time, and there's a very common misunderstanding about how risky these are. Are they risky? So the risk level of an HYLD is very, very similar to just owning the S&P 500 hedged to the Canadian dollar, like owning VSP. USCL, the risk is very similar to VFV, and QQCL, the risk is very similar to owning QQC, which is the Canadian QQQ, right? So the risk level is like owning the indexes themselves. HHIS is another monster. So this one is, the way I look at it, and again, I have a video that just came out, HHIS breakdown. The way I look at it simply is a concentrated NASDAQ 100. So almost all the stocks in there you'll recognize. They're all the top stocks of the NASDAQ and the S&P. Microsoft, Apple's going to be there, Meta's there, Tesla, Nvidia, you just have more concentration there. So it's a little, I guess you could say it's definitely more risky than just buying the S&P or the Nasdaq because you
Mhm.
have more concentration. But the format is completely the same. Covered calls, 25% leverage. But because you have more concentration, because there's a lot of more volatile stocks in there, like Tesla and Nvidia and Palantir, MicroStrategy, you're able to generate a lot more premiums because covered call premiums are based on volatility, and those are more volatile stocks than the S&P 500 index or the Nasdaq 100 index. So they're able to generate about 25% yield on that fund. So
That's what I was
HHIS
looking at.
right now is just under $12. The yield is a little over 25% right now on HHIS. And that yield is very sustainable. Most people think it's just crazy, but it's sustainable because those stocks generate those types of call premiums. It's as simple as that. Plus there's 25% leverage in there, which is, classic borrowed money that the fund manager, it's not you borrowing the money, it's within the ETF, which is great. They get the
Yeah.
best borrowing rates. Rates are very low in Canada. So the way I look at HHIS is kind of like a concentrated NASDAQ 100, if you will.
Is HHIS US hedged as well, or is that not?
No. So the only one that's hedged to the Canadian dollar is HYLD.
HYLD.
Of course, they have HYLD.U, which is not. But
Yeah.
everything else, USCL, QQCL, HHIS, everything else is not hedged to the Canadian dollar, which means if you like the USD better than the Canadian dollar, that's what you would go for. That's what you would prefer.
Also, for your tax purposes, it makes more sense, correct? In being in
Yes.
Panama?
Yes, because if I would hold,
Yeah.
well, first of all, there is no US equivalent, US listed equivalent of these
Mhm.
with 25% leverage. You could find a million S&P 500, NASDAQ 100, Russell 2000 sector, single stock, covered call ETFs in the US, but none of them have the 25% leverage. So I feel the Canadian one's always going to have that very superior edge. On top of that, I would pay a 30% withholding tax in my cash account instead of 25, and I wouldn't get anything back. So especially
Yeah.
for a non-resident, it's completely not worth it. But even for a Canadian resident, it's still not worth it. You might as well stick with the Canadian listed ETFs in your TFSA and cash account, especially.
So on this one, you have total investment of 505,000, your weight 30%, 31% of your portfolio. Like the yield here is 24%, that probably fluctuates, and you get paid $10,000 a month. So guys, right now we're at about over $20,000 a month.
Yeah. Keep in mind that the monthly distributions could vary. It's
How much do they
possible.
vary by? Is it erratic, or is it like a lot, or you still
It
roughly know
depends
how
on
much
the
you're getting?
fund.
Yeah.
Right? Because if you're doing covered calls on a single stock like MicroStrategy, for example, it's going to be more erratic because
Yeah.
MicroStrategy is more erratic. So the more boring the thing is, most likely the less fluctuations you will see up or down. Right? So
Do you even care? Tell me the truth. Like, because you're getting $25,000. Your living expenses are like, I don't know. We're talking about what you're doing with this, by the way. Are you reinvesting it? Are you living off it? But if you're in
we
Panama,
can talk about that.
yeah, living expenses can't be the craziest because you're in Panama. You're not unless you're crazy and you're just like this every day. You're not blowing through $25,000 a month in capital, right?
No.
So it's like if it varies, you're like whatever. You just go about your business, right? You're not. It's not like you're a retirement person. You're on a more modest yield where you need to get paid that $3,000 to $5,000 a month because you got fixed. You got bills. You got to pay fixed, right? Like this is the varied element. I don't think it wouldn't bother me that much. I'll be honest. If it
can't
fluctuated by
bother
even
you it can't bother you because
yeah
it's just the way it is. This is
yeah
these are not dividends from dividend stocks. Like Bell just cut
yeah
their dividend, big
yeah
disaster. These are not dividends. These are call option premiums. It's
yeah
completely different. So by nature, they vary. The Canadian fund managers, I talk to all of them. They know, they're not stupid. They understand that people are relying on these distributions. So they do their best to keep them relatively even. Some of them are taking in, some months take in more than what they give out, but some months they take in less than what they give out. So what they typically do is they do a report of the last year or 2 years and what is the average, and they
yeah
typically give you like an average that they take in. But sometimes they do have to adjust them because they want to be responsible and make them sustainable. So some people get upset when they see a reduction. They get happy when they see an increase. I'm agnostic when I see both because I understand that it's just a game.
Part of it.
I'm happy getting income anyway, no matter what. So I don't
Well,
care. That comes with experience.
let's hammer home this one point. Like,
Sure.
they're call options, they're not dividends. Like, people need to understand that. They need to understand. Can you, in layman's terms, because I know a lot of people watching this aren't familiar with it, explain exactly what call options are, how they're paying you out exactly. It's not from dividends, it's from premiums on call up. Just simplify as much as you can for anyone watching.
So you know how there's a stock market where stocks are traded? There's also an options market where options are traded. So there's two types of options, a buy option and a sell option. So a buy option is a call option. So they are selling call options. So call option, when you sell one, you're basically and it depends on how much of the portfolio you're doing this. In Canada, typically nobody goes over 50% of the portfolio. So what they're doing is they're selling call options, and that's how they're making their premiums, their dividends, if you will. They're technically called premiums, kind of like an insurance company that takes in premiums from their clients. So basically, the general premise in layman's terms of what you're doing when you're selling a call option is you're giving up a certain percentage of the upside of the asset, of the stock, right? So if you're writing covered calls on MicroStrategy, it means you own MicroStrategy stock. You're selling call options at a higher price. So let's say MicroStrategy is at $100. You sell a call option at $105 and it expires in 30 days. Typically, options expire in 30 days. So basically, you're selling someone the right or the privilege to buy your MicroStrategy shares at $105. That's basically an example of a call option. And for that privilege, you're getting paid a premium no matter what happens up front. So at the end of the 30 days, if MicroStrategy stays at 100, goes to 101, 2, 3, 4, 5, even 105 or less, the option is worthless because there's no way they're going to buy MicroStrategy off of you for 105 when they could just buy it at the market for less than that. So the problem, or when you get called away or when the option gets exercised, would be if MicroStrategy ends up being $110 after 30 days. So of course they're gonna say, "Give me your shares at 105," because now they're at 110. So as the option writer, the seller, you're giving up MicroStrategy past 105, the price past 105.
Yeah.
Well, hopefully that makes sense.
Are they making millions off that strategy? Like individual investors doing call and put? Do you know, or are they just making short-term cash flow that doesn't really equate to much?
I know a guy who he's really good with this stuff, and he has a lot more money than me. He's also in Canada, and he just doesn't want to pay the ETF fee, so he has a lot of this stock and that stock, and whenever he needs some cash, he'll sell some call options. Like there's a million different combinations of ways you could do it.
Yeah,
but I'm not sophisticated enough to even start trying to do it. Like I don't.
Yeah, that I have zero interest in that, so we're gonna move past that as well. Let's go to the last one, MSTE. That is the Harvest MicroStrategy Enhanced High Income Shares. MSTR stock with covered calls, and
25% leverage. Yeah. So MSTE is one of the 14, soon to be 15 in HHIS. So HHIS is really let's just say 15. When the Apple one comes out, it's going to be 50. HHIS is a combination of 15 Harvest single stock covered call ETFs, right? So HHIS has 15 of those, and MicroStrategy is one of them. Or so this MST is technically one in HHIS. So it's just MicroStrategy stock. If you go to the website, you look at holdings, it says MicroStrategy 125%, and they're just writing covered calls on that stock, but they write only between 33 and 50% of the portfolio, which means by default they never write more than 50.
So they still capture some of the upside on when there is
50%, but probably more because I think they started about Harvest typically does 33. typically, but they could go up to 50. So they're making all those premiums, and the premiums are very, very high with MST. That's why you see the enormous yield there.
55%. 55%.
Yeah. And that's not even, that's on less than half the portfolio. Imagine,
Yeah.
right? That's why the yield max one is like 100% yield, because they're writing on 100% of the portfolio.
Okay, so let's talk about this for a second, because that's 55%. So how much is it depreciating by every month? Like, are you have to keep reinvesting your profits into it?
I actually have massive appreciation on it, because MicroStrategy is going up or has gone up. The ETF will appreciate or depreciate with whatever the underlying asset is doing.
Asset is, yeah.
Yeah. But on top of that, you have to remember that, you know, right now the monthly dividend, which could change, is 66 cents a share per month. You have to remember that on any ETF, on any of these, every month on the X dividend date, the ETF stock price is going to decrease by the amount of the dividend. So on every X dividend date of MSTE, the stock price, you're going to wake up in the morning and it's 66 cents less. That's because the premium is coming out of the net asset value of the ETF every month. And then they give it to you as cash. So a big misunderstanding, a big thing people always say about these high yield ETFs is they have depreciation, there's NAV erosion, there's erosion of capital, there's capital erosion. It's not true, because the 66 cents is not going in thin air. It's being given to you in cash, and you could do whatever you want with it.
Yeah.
Right.
Yeah.
So these
yeah.
ETFs, you can't look at stock charts. You got to look at total returns. You got to count that 66 cents every time as well. Right.
So when I'm looking at this, we were talking a bit off camera. I was saying, yeah, I bought Hamilton ETFs because I didn't want to put it in a GIC. I didn't want to put it into a high interest savings. I just wanted it where I could liquidate it really fast, because I had about $100,000. I was just like, all right, I just want it available. Let's say another market crash happens and I want to snatch up a bunch of stuff. I can just sell that. It's liquid enough. I can sell it next day. I can buy $100,000.
You could buy and sell them like a regular ETF. Yeah. My personal opinion, I think these are designed to really buy and hold and collect the income, but you could buy and sell them. You know, if you get kidnapped and you need some quick ransom money, you could sell them. But I would try to never sell them.
Well, let's talk about what I should do then, because I own UMAX, I own HYLD, and I own HMAX, and I have 50% of it in UMAX, 25 in HMAX, 25 in HYLD. I have so much US exposure. I was like, great, I'll just have UMAX and stuff as like Canadian exposure. Plus you get a dividend tax. If there's dividends on it, I guess I didn't fully understand it, but dividend tax credit and all that stuff. But now that I'm looking at this, I was like, great, I can have it there. I can collect some dividend. I get some yield. So I get to make a little bit of money while I hold it there. But I'm thinking, why don't I just put $100,000 on MSTE and just collect $55,000 a month? And
yeah, like, a lot of people have that question, but you have to remember your risk is much more elevated. So you're still investing in MSTR, whereas UMAX or HMAX, you're investing in 10 to 15 Canadian utility stocks or Canadian financial. The risk level is completely not the same. Right.
But if you look at my perspective, risk is what? Is it going to drop to zero? Am I going to lose $100,000? Like, if I'm holding
$1 question, what is the risk? Right.
Yeah. And then I don't care that much. I don't need this money tomorrow. I literally just have it there as like, if I ever feel like I just want $100,000 to go buy some random stock that I think is so undervalued that I can just buy into it. It's not in a registered tax shelter account. I could easily hold it for 3 years and just pays off of yield payouts. I made up the difference just off those monthly payouts. Like, that's what I'm saying. Like, is it that risky, really? Even if it dropped half in value in a year and I held it for 3 years, I would still technically, unless they didn't change the yield drastically, it wouldn't be that painful. Like, am I thinking right, or am I completely off track here of how I'm thinking?
No, you're not thinking wrong, that's for sure. But you have to remember that your risk is still associated with the underlying asset. So would you let's say you were a growth investor, would you put it all in MSTR and ditch your S&P 500 and NASDAQ 100? And by the way, don't think I don't ask myself or simulate what if I just sell my HYLD and QQCL and USCL and put it all just in MST and HHIS? I'll probably be making like $400,000-$500,000 a year of dividends. Yes, but it's really about how much volatility and how much capital fluctuation you could stomach in your
I
account.
think it'd be because I'm coming from a similar position as you, where I have quite a large portfolio in my safe ETFs, in VOOs, in VFVs, and stuff like that, where I never sell them. They're just there.
Yeah.
Where I'm okay. I'm okay no matter what. Like I could retire by 45, 46 and be completely done. Where I have room for high volatility, where I go, oh, this isn't going to make or break me, regardless of what happens. It's should I add some volatility into my portfolio? Should I just weave this in? And that would be the only time I'd be thinking about.
Yeah. High risk, high reward, right? That famous line that's really what applies here. So yeah, I mean, if you put it all in MST or a big chunk in MST, you're going to get that massive yield. And if MicroStrategy does really, really, really well, you'll appreciate, and the performance of your MSTE will be more or less similar to MSTR.
Walk me through your process. You own $115,000. What was your decision making? Just walk us through. What was your decision making process to be like, I'm going to add this?
Said, you know what? I'm going to go about 10% Bitcoin exposure, and the rest in big cap US indexes. So my process or my thinking is that the question I ask myself all the time now before I invest in anything is this thing going to beat the S&P 500 or the Nasdaq 100? These things are almost unbeatable by stock pickers. And if you look at Canadian stocks, Canadian indexes, they never beat the US indexes over time. I don't care about last month or last 3 months. I care about the last 5 to 10 years and the next 5 to 10 years. Europe doesn't beat them. Emerging markets don't beat them. Nobody beats the US. Nobody. So this is why I have my baseline core in the S&P and Nasdaq. I also think index investing is personally one of my favorite and the best way of investing and easiest, because when you're investing in an index like the S&P or the Nasdaq, they're constantly changing. The index is constantly rebalancing. It's like auto diversification, auto adjustment to the best company. If company gets better and better and bigger, it's going to take a bigger percentage. It's like capitalism is almost embedded in the index style. You know what I mean? So I love that. But HHIS, you know what? Concentrated. S&P or concentrated, Nasdaq, those 15 stocks make up such a big portion. I'm okay going a third there. Maybe someone is okay going 50%. Maybe someone is okay doing 80%, or maybe someone's not comfortable and they'll do 10% HHIS, the rest in the S&P, Nasdaq, or some Canada. This is where do-it-yourself investing becomes a blessing and a curse. A lot of people, the biggest question I get all the time from newer people is, what percentage do I put in what? The answer is there is no answer. There is no magical formula. It's really up to you to figure out what you can stomach.
This is fun for me though. I like talking shop a little bit. This is a little bit fun for me. And I really want to be very clear with everybody. We're not financial advisors. I am one guy talking to another guy, and we're just having a little bit of fun. I'm throwing out crazy hypotheticals. Do not expect me to act on anything I'm saying. I'm just having a lot of fun because I know he's the pro in this area. So I like throwing him these scenarios. And then internally, I get a little bit happy talking about it.
It's fun. It's fun to talk about for sure.
It is fun to talk about. It's very different. If I were to actually put $100,000 on something, I don't think I'd be having a lot more fun. I'd be a little more stressed out, especially since I'd have to do a lot more research before I do any of these decisions.
Especially if it went down 50%. If it goes up, if it doubles or triple, you're going to be happy. But
big difference between us talking, having fun here, talking about it, than actually doing it. I think though, is you mentioned MSTE is being incorporated into HHIS. Are you still going to keep your position in MSTE, or are you just going to liquidate it?
I will. To me, so the way I look at it, so I really like Bitcoin. I'm not a crypto expert at all. I guess I could say I understand Bitcoin. I find it very fascinating. I'm a huge Michael Saylor fan. I will admit that right away. Just watching his podcast, watching him talk, it's like I'm mesmered. I can't, everything he says makes sense. I also, did some research on him. He kind of predicted the Mag 7 years ago that they were going to take over, and he was right. So his conviction, his confidence, and what I see happening the Trump administration, very pro crypto, the fact that more and more companies are buying it. I think the ship has sailed where Bitcoin is no longer just a speculative asset. This is,
Yeah, that's
I think it's very special and unique, and it could be the, it could be the biggest life-changing thing for my portfolio. And I don't need my portfolio to live off of. I have other sources. I'm blessed to have other sources of income now, the YouTube channel, other things. So I mostly reinvest everything anyway. So
yeah.
I'm comfortable to go to 10% exposure to Bitcoin, and I actually am going to raise it to 15. Some people are 50, man. You know what I mean? Maybe next year I'll be 20, 25. So the more my confidence level grows in Bitcoin, the more exposure I'll put. But I'm still an income investor at heart. I'm still going to be investing in the leveraged covered call ETFs. That's just what I love. So right now, MSTE, um, Michael Saylor says it's like a leveraged investment in Bitcoin. If you want to buy Bitcoin, buy Bitcoin. If you want to outperform Bitcoin, buy MicroStrategy. But you're going to get a lot of volatility and a lot of swings. I'm
Yeah.
okay with that. So for me, MSTE, HBIX, which is just Bitcoin, and then you have HBTE. These, by the way, they're all Harvest products. I think what Harvest has done for Bitcoin is really, really good. They came out with an ETF HBT called Bitcoin Leaders. So in there, you have 15 companies that are involved in the Bitcoin ecosystem. So MicroStrategy is actually there. Block is there. Coinbase is there. Marathon, Galaxy. You have a little bit of Bitcoin itself and a bunch of little crypto miners in that ETF.
Yeah.
And they're writing covered calls on it with 25% leverage. And then you have the Bitcoin, which is kind of like the boringest one. So those three exposures for me make up my Bitcoin exposure, which is I'm planning to make 15% overall in the next couple of months.
You mentioned Harvest, like you're dealing with Hamilton, Harvest, you got Global X. You're only dealing with highly reputable companies that you know are good for it. You don't have to get, it's like they remove that headache. You're good if you buy one of their ETFs. Yeah.
Yeah, there's
Like that's what
definitely that. I know all of them. I met all of them. They're good. They were good friends even before they became sponsors of the channel. They approached me.
Mhm.
The most important thing is you have to understand what they're doing and what their strategy is. That's the most important thing. I have the utmost confidence in all of them. I know exactly in black and white what the covered call strategy is. How much are they giving up upside?
Yeah.
And proof is in the pudding. Their other ETFs do really well. So as long as you understand this, it's more about understanding the product and the ETF and the strategy than Hamilton versus BMO versus, like BMO, for example, a lot more bigger and reputable, you could say, but they don't have any of the cover call strategies that I like,
Yeah.
right? They don't have any 25% leverage ETFs, and they mostly stick with dividend stocks. They're more boring, sector specific. I like the indexes. I like, more what Hamilton Harvest and Global X do, that format,
So
right?
like, I have my eye on HHIS. I'm just going to like the idea of if they're bringing on MSTR, so 15 with covered calls. I like obviously their high yield of 23.85. Maybe something I'd hold for a year or two for that with that money I have.
Yeah, it's like 26 now.
Which
Right
is
now.
crazy.
Yeah.
I just like that. But then could I go to your channel and just to get started with my research, find relevant videos to just about HHIS? Do you have any content on
Yeah, for
that?
sure. So the best thing to do is search my channel and put the stock symbol you want. And if it's a hot, high income one like HHIS, and for all of these, you'll find the related videos for sure. So HHIS, I have a recent one where I kept getting questions about or kept seeing false information about it, that it's too speculative, it's too speculative. It's typically people who talk like that and say that kind of thing, they don't really understand what they're investing in. It's very simple. An investment in HHIS is an equal weighted investment in 15 companies.
Yeah.
Apple, Microsoft, Tesla, you go through the list. None of those companies are small fries, small little companies. Some I guess you could call speculative, like Palantir maybe and Tesla, but to
Yeah.
me they're not really. HHIS, a Harvest has chosen more innovation type companies to go with HHIS to really sustain high yield, because innovation type companies, aka tech companies, there's simply more volatility in there, which means more call premiums, right?
Yeah.
It's only natural. But you
Okay.
have to like those stocks. Don't
Yeah.
invest in HHIS if you don't like the 15 stocks in there,
Yeah.
because that's what you're really investing in. You got to look
Yeah.
beyond the ticker.
You always have to look at the underlying assets of
Yeah,
each one.
always.
I want to talk a little bit about now because most people on my channel were long term. They're actually, I find my channel breaks up into two buckets. Either people with over 10-year time horizons who are looking for capital gains. What am I going to have by retirement? Or people who are actually in that transition period or in retirement. And I feel like this is the people who are going to be really interested in this, or like, hey, I need income to live off of. I get emails all the time now of covered call strategies and stuff like that. I actually send them over to your channel, like just go look at his content. But I think this will be relevant to them. I'm going to tell you where my brain is at, and I'm going to guess why you picked this strategy, and you tell me how close I am. So the reason why I do what I do is I'm focused on capital gains, right? I'm just trying to front load as many capital gains as possible, slowly transition into more income oriented investing when I'm ready to start milking that for cash. But that might not even be for a long time. Retire by 45, but I might not even use this cash till I'm 55, 60, who knows, right?
Yeah.
Switch it over then, see how big that pot is, go from there. I have that extra income. That's really an emergency fund for me. It's just money I have that it's like, if my house catches on fire, I can fix some stuff. If something happens, that's all it is. So I wasn't using it for anything. I didn't want to put it into a stock that was VOO, VFV or something, because I don't touch those. So I can't put it there. And everything I do is long-term holds. If I was going to use it, it would be for something where the recent market crash, I bought everything at a 40% dip. Maybe I'll flip it in 2-3 years when it's an all-time high again, go buy something else with it, right? And that's what I'd be waiting for. So my reason for covered call was very much, I'm not a covered call investor. I got money. I'm literally purposefully not allocating anywhere else. I need it to be as liquid as possible, but I want to collect as much interest on it as possible. I don't want to put in GSE because I think there's better options than that. I landed on Hamilton ETFs because I was really familiar with Hamilton ETFs from my previous work, working in advertising for publicly traded companies. So I knew all about them. Same with Harvest. So I went with them because familiar, I knew they're trusted, yada, yada, yada. You're young. We're around the same age. I'm thinking you just went, I don't want to wait till I'm older. I want to chill now. This is a strategy that I can, because you're reinvesting a lot of it. You're building up other income sources, but you're like, if I really wanted to, though, I could just stop doing everything and just go on autopilot for the rest of my life starting right now. So it's more like I want to live good now, and I still know I'll be fine later. And it'll just be all good. Like maybe I won't have the same capital appreciation as Gary does at that point, but do we really care? Are we arguing over pennies at this point? Does it really matter at that age? So I'd rather just have all the benefit now and have the benefit later. It was more like a mental thing, or am I way off base on that?
No, I think that what you're talking about is how most people see it. With time and experience, I kind of see it differently. The last thing you said really resonates more. It's a mental thing. So the way I like to explain it is, if you're gonna go with VOO, the indexes or growth stocks or whatever, it's fantastic. I'll never not. I like all styles of investing. I think there's three styles. There's growth, growth stocks, passive index ETFs like the S&P, the Nasdaq. There's the dividend style, which is you're only focusing on dividend stocks, not covered call like Bell and Telus.
Yeah.
Well, forget Bell, bad example. But
Yeah.
utilities and healthcare stocks, that financials, they have a lot of dividends, and they typically grow their dividends over time. Then you have the income investor, which you're trying to maximize income. But I feel like income has a big advantage over dividends, because dividends, you can only buy and invest in dividend stocks. What about all those fantastic great growth stocks? So as a covered call investor, I could still get the indexes, and get growth stocks, and as long as they have covered calls, I turn them into an income investment. So it's more about, I don't have to worry about selling anything down the line. I'm not as dependent on the stock market as you are. You are going to have to sell at one point your VOO to make capital gains. Like you said, you're chasing capital gains, or when you want to retire, you're going to have to swap into more
Yeah.
dividends or income oriented fund. I don't want to have that problem at all. I don't want to be dependent on the market. I don't want to care if the market crashes 30, 40%. To me, it doesn't matter because with this strategy, I never have to sell anything. Another thing I will tell you, there's a big misconception around the word growth or capital gains, as you say it, as you said it. So growth, what are we trying to grow? Most people, when they think growth stocks, they want capital appreciation. They want stock prices to go up so they could sell them and make a profit, aka a capital gain. But it's really not the growth of the stock price you should be worried about. It's the growth of your money, of your investment, right? You put in this much, after 10 years, you want it to be much higher. You want that to grow. So there's a lot of people in my community that are young or have 10, 20, 30 years left. They're still going with this style, and I would still go with this style even if I was 18, because here's the beauty of it, it's the flexibility with this strategy. You have flexibility, the growth investor does not. The growth investor, when he needs cash flow, that there's an emergency, they have to sell units. Also, to realize their profit, they're going to have to sell at some point. Trust me, I've met with over 1,000 people. It worries people. They're always looking every day. When do I sell? How much do I sell? What do I do with the money afterwards? These are all mental problems that I never have to deal with. And here's the beauty part of it. If you like VOO or the NASDAQ, QQQ, or QQC in Canada, or VFV in Canada, you could just get USCL and put it on drip. You could just get QQCL, put it on drip, HYLD, HHIS, put it on drip. If you do that, you're kind of turning your income investment into a growth investment. And then later on, if you need cash flow, if you're starting retirement, you don't have to sell anything. You could just turn the drip off. So you have much easier time and less to worry about later on. And here's the beauty. The performance is more or less going to be the same.
I was going to ask you.
But if you do USCL versus VFV, HYLD versus VSP, QQCL versus QQC, what you'll realize is that thanks to that 25% leverage, the performance is extremely similar, if not identical, to the growth one anyway.
As long as you're reinvesting that drip, obviously, right?
As long as you're reinvesting, but even if you're not reinvesting it and you're taking out that cash, it's still similar.
Really?
But yeah. So if you go to like the Canada Stock Channel, there's a tool where you could do a total return, and it shows you the total return with dividends reinvested, dividend without the reinvestment. So it's like you're spending them. It's typically a little bit lower the return if you're spending them, but it's still very similar. Will USCL beat VFV in the next 10 years? I don't know. I have no idea. I know that it'll be pretty similar. The leverage certainly helps. If the S&P 500 does really well and interest rates are down, leverage costs are low, maybe USCL will beat VFV. I don't know. But what I'm trying to say is that in terms of, you can't just look at yield. You got to look at your overall performance, your total return, which is what people should be saying. Instead of growth, say total return. That's the best way to look at it, right? So these are very performant as well. They have great growth and great total return as well, if not the equivalent of the underlying without the covered calls. And that's thanks to that 25% leverage. If you just do S&P with covered calls, no leverage, you're not going to beat VOO. You're not going to beat VFV. It's impossible, because if the S&P goes up over time, covered calls, meaning you're giving up some of that upside. So in a long period of time, you're not going to outperform. But that 25% leverage seems to have been like the sweet spot, or that holy grail, where it helps to bring up, covered calls lowers the return. It gives you yield, the monthly cash flow. It's beautiful, but it lowers your performance over time. But
how often are you adjusting your portfolio? You got 5 core ETFs. This is your core positions.
My goal is to never adjust it anymore. Like
you got your ratios. It's so simple. It's 30-30. Like you got it. Like it's nice. It's clean.
I came up with now. Maybe I think I'll be more risk tolerant as I get older. So maybe instead of 30, 30, 30, 30, it'll be like 20, 35, 35, right? Because
Mm-hmm.
my portfolio, the more down you go, the higher the risk goes, right? So the S&P is
Yeah.
the most boring. The NASDAQ, not not that much more risky, but a little bit more because there's such
Yeah.
overlap now with the NASDAQ S&P. HHIS more risky because it's more concentrated. But another thing you got to remember, over diversification, lots of diversification is not necessarily a good thing for total return.
Yeah.
Right. You see a lot of geniuses like Warren Buffett and Mark. Well, I don't know if Mark Cuban's considered a genius anymore, but Michael Saylor, they all say diversification is a pretty bad idea. I mean, Warren
Yeah.
Buffett said it on
He
one
says it.
side, it's
Yeah.
pretty stupid. But then
Yeah.
he said, well, this is what I meant by it. Diversification is not for you to increase your performance, it's to it will literally give you average performance. That's what it
Yeah.
does. So example, if you just bought the Magnificent Seven for the last 10 years, you would have done much better than the S&P, much better than the NASDAQ, right? You're less diversified, but you're getting more return. So for me, it's really about the portfolio, the percentages on what I could stomach comfortably, my wife and I, because it's not just me,
Yeah.
but because we don't, we have no kids, because we have other sources of income, we could maybe take a little bit more risk. But to me, the risk of my portfolio is not that it's not high. If you take the average of like the S&P, the NASDAQ, and HHIS, the average is like of risk is to me is the NASDAQ 100. It's not
Yeah.
that risky to me, but for some people it is, right? So this is really, it really depends. So maybe as I get older, I'll care less. I'll have even more stomach for risk. Maybe I'll go to like 20% Bitcoin and 40% HHIS. Like, I don't know. I'm just going with feeling and experience and things like that. So,
That's important though, because you got to invest on where you are in your personal life. Don't ever copy what I say or what Adriano says. It's
no,
like
you shouldn't copy
take
anyone. You
take
should,
take inventory of where you're at and
yeah,
where you're at with your life, what risk tolerance you have, what is literally your financial situation. Do not invest a penny if you think you might need that money in the next 5 years. Like, do not spend money you don't have like ever. To make sure you have your emergency fund set up. Make sure you've done all your financial planning. And I really want to hammer in people's heads. Me, I have a whole portfolio. I have other streams of income. I'm this kind of investor. A lot of people watching are similar to me. I'm considering this personally because I have room to take on higher risk stuff. I can even get into the micro strategy if I really want to, because it can fit my lifestyle and what my circumstances.
yeah,
Please do not even think about that. And Warren Buffett, back to him, he always says he invests in his sort of sphere of knowledge where he's not good at like every type of investing. He's like, he knows his lane, he sticks to it, and that's why he's so successful. It's like, make sure you do your due diligence, check out passive income investing and check out all the content there before you even start. Like, don't just be like, yeah, Gary got hyped up about MSTE, I'm going to buy it too. No. I'm not. I'm going to put an extraordinary amount of hours before I purchase anything. Like, I'm going to put a ridiculous amount, like
yeah,
crazy amount. And then when I feel like I'm oversaturated with knowledge, where I feel like we could actually have a conversation where I know just a little bit less than him, then I'll feel comfortable enough to start investing. I had a podcast with Ron from Ron's Basement. He's a gold investor, silver, does crypto. He did me introductory in gold and silver. I'm like, oh, I should probably add that to my portfolio, but I have a long ways to go before I feel competent enough as a gold and silver investor to actually start purchasing those stocks. So do what I'm doing when it comes to research. Spend an ungodly amount of time doing research where you almost feel like an expert before you invest even $1. Now, I want to talk about you now. I'm so interested about everything you've done. So you're living in Montreal. You're
yeah.
working a regular 9 to 5, right? And you mind asking what field were you in before all of this? What were you
Both my
working?
wife and I were in the tech field,
Okay.
but not in the technical tech field. Like we weren't programmers, more in the management. So we both started at the help desk, customer service, technical, and then I went to incident and problem management. So incident problem management is just a very unique job that I was pretty good at. You have to be cool under pressure, but basically it's a 24/7. You have a pager. I had a pager. I worked night shifts, and they would call me or I would get paged for a major incident. So one of my biggest clients at the beginning was Bell Canada, but then I went to Air Canada. So for example, if the Air Canada website is down, that's like the end of the world severity one incident. It means every second that it's down, they're losing X amount of money. So typically I would get called on incidents that are the companies were losing money.
Yeah.
So that's what I did. I was an incident problem manager. So I would organize a conference call, and I would get the server guy and the application guy and the database guy. And I would deal with all the technical guys, which were very eccentric people, very fun to deal with. And I would do like a war room, and we need to figure out how to solve this as soon as possible. And I would keep upper management informed during the incident. That's incident management. That's what I did before.
Do you think that helps with stress management? You did that
Definitely.
for long enough. So when you start doing high risk covered calls, you're like, this ain't nothing. Your brain's almost like conditioned to not freak out.
But that's why I fall asleep, because covered calls lowers the risk. It's not risky, right?
Yeah. Oh yeah. You mentioned.
Why.
Yeah.
But I would say I'm a fairly cool, calm, and collected type of guy. You have to be for that job.
Yeah.
I mean, it certainly helped. It certainly helps, I would say, but not financial at all. But I've always had an interest in stocks and finances all the time. And, during our careers, my wife and I weren't really investing that much. I was swing trading. I was buying like BlackBerry and Bombardier and even Air Canada at one point. I was just buying like distraught companies that are really low. Oil stocks, Canadian oil stock, just to maybe flip them in a few months and make some money. Over time I made more money than I lost, but it was too stressful. It was such a waste of time. So my wife and I, throughout those like 7 years at the beginning, we put all our disposable income paying off our mortgage. That's really our story. What we did, we got our 20-year mortgage paid in like 7 years.
Jesus.
Yeah. And it's at that point where we started thinking, okay, what are we going to do with all this disposable income? So that's when I started doing more research into dividend stocks, income-oriented stocks. And if you look at my very first portfolio in Vail, I have like a mishmash of everything. Some covered call stuff, but a lot of single REITs. I had like Bell and TELUS and CIBC, Scotiabank. I had a bunch of dividend. I was just trying everything because I had all this excess money once the mortgage was paid. And then slowly, gradually started discovering covered call stuff and split funds and things like that. And once we hit $1,000 a month, we're like, holy crap, this really works.
Yeah.
And then we just started doing hypotheticals. What if we sold a condo? Because we bought a condo in a really good place in Montreal next to a metro station. What if we sold the condo? How much could we get? What if we invested all? How much would we get? Well, we would get X amount of money per month, which means we could easily pay all our living expenses. So that's basically what we ended up doing. We sold our condo. My wife quit her job because she was unhappy. I was okay at my job. I stayed on for a year because we don't make any spur of the moment decisions. So she quit, but I stayed on just to prove the system. And after another year or so, or less than that, I quit also. And then everyone started asking us, what do you mean you quit? You're like 35. Well, what the hell is going on? I would try to explain it to them. I'll never forget this. It was at the gym. We were going to the gym. We were trying to explain to these kids what we were doing. And because they're, how did you retire at 35? Well, this and that. And they just looked at you like you have no idea what you're talking about. So in the car on the way home, I don't know if it was me or my wife, we said, you know what, we might as well put it on YouTube just to save time so we could just send people there.
Yeah.
That's how the channel started, basically.
That's funny. That's sort of how my channel started, actually. That's weird. It was just because it was answering questions from my friends and stuff, and I just got tired of it. And I was like, I'll just start doing some basic investing advice.
Exactly.
I want to go back a little bit. Did you and your wife work together at the same job? Is that how you guys met?
That's where we met. We met at CGI, which is the biggest IT services company in Canada. So we met there. I went there straight out of college. Actually didn't even finish college. I got that I was very lucky. I got that as a summer job, and I just didn't feel like going back to learning C++ and programming. And luckily I made the right decision because nobody uses that crap anymore. So just stay with the company. So I started when I was like 19, 20. And we moved up. We both became managers, and we both had, my wife at one point had like 100 employees. I had maybe 30, 35 incident managers. And then I got another opportunity to go to another company. I took it. And then eventually we got ported to Air Canada. I was with
Yeah.
Air Canada for a year or two, and then ended up quitting. But the whole career was in that same, incident problem management field.
I'm always intrigued by husband wife combinations because I have my business now. My wife and me, we own the business together, and she's involved. Like, so she's involved with it. I met your wife once. I've spoken to her once months ago. She's impressive. She gives me the. Is she involved in operations? Is she the one keeping the day-to-day operations running with the business? Is that how it works? Like,
She's definitely involved. She's more of the creative slash marketing, I would say. I'm more the operations,
operations? Okay.
filming, and but we're also thinking of starting a podcast as well. She's going to spearhead that. So we've both, like, when we were both very entrepreneurial.
Yeah.
So we met, and we right away, even before dating, I think we started doing these little side hustles together. So back in the day, the biggest thing was reselling on eBay. So we ended up making these, I don't even remember how, these connections in China. We would import stuff from China, then resell it on eBay. We were doing a lot of side hustles together, even before we started dating. So we're very entrepreneurial by nature. So I don't see us ever like stopping, doing for us, this is kind of a full-time business now, but we do it because we like it. I love it. I mean, I could talk about this stuff all day.
When did you guys start YouTube? How long ago was that?
I'll never forget because it was just a few months before COVID. So it's very hard to
Wow.
forget. So just a few months before COVID, November or December of 2019, I believe. Yeah, is when we sold the condo and put all the money in. So we actually experienced a big crash 3 months after we went all in. So trust me, now that was a huge learning experience. You'll never, you could be an investor for 10 years, but you'll never learn as much as in a big crash that period of time. So once you go through your first roller coaster ride, the second, the third one is a lot more boring. So it kind of also proved the concept as well of not needing to sell, just living off of the income.
That's true. Because you didn't have to,
Right?
you just were like, whatever. It's like, I never plan on selling this.
Yeah.
And was it your idea with the covered calls? It was you came across it. You were
It
like
was
to
me
your
who
wife.
discovered the funds, but at that point, it was just a mishmash of dividend stocks and REITs, covered call ETFs, and closed end funds, split share fund. I literally went on the TD. I was with TD Broker. Now I'm
Yeah.
with Questrade, but you could go through you could do a screener. Show me everything over 5 or 6% yield. And I got the lists, and I just took the lists, and I just started doing research on them one by one. And that's how I started discovering covered call ETFs, closed end funds, split share funds, and started investing in them even before understanding what they really were. I just saw the yield. I looked at the dividend history.
Yeah.
And
Make sure.
from there, from knowledge, researching, going on the fund manager's website, learning what are covered calls, it takes time, but you learn and you learn and you learn. And eventually we narrowed down that the cover call strategy was really the best thing for us. It's the
So
most
let's work through this.
consistent thing.
Let's work through this timeline. You get the job, you and your wife. You come across covered calls right before COVID. You're all in.
Sell
COVID
the
crash
condo,
happens.
go all in.
All in. But then COVID crash happens. Did you see an uptick in viewership on your YouTube channel because everybody was now locked at
Yes.
home at some point? And finance channels blew up in this window. A lot of guys I know
Yes.
who are in finance all built their channels in this window. I came way
Yeah.
after. So,
Yeah, for sure. It was so I think our channel launched in February, March
which is right when it
of
happened.
2020.
Yeah.
And really the big catalyst was our third portfolio unveil video. And to this date, after 5 years, it's probably one of our most viewed, most popular video. I don't know what happened, but to get to 1,000 subscribers, it took like 6, 7 months. But after that video, we just kept looking on the phone, and the subscribers were jumping by dozens like every second. So it was
Oh, wow.
crazy. It was the third portfolio unveil video that third or fourth, I can't remember. But that's when the channel started accelerating, and the rest is history. Now we're about to hit 100,000 subscribers, and not yet, but we're getting there.
Wow.
So
And there's a couple of things people can do. Like when I was going through when I was going through your YouTube channel, they can grab your ultimate DIY investing package. You guys have that on your YouTube channel. You have your membership services on your YouTube channel. So is that what you typically do day to day now? Your operations is like, because you pump out content you pump out a lot of content, like
yeah,
every other day.
yeah, so at the beginning I used to write scripts, and it
Yeah.
was so long I was reading off a page. Now I just, luckily, I think one of the best classes I took in college wasn't the computer stuff. I didn't even finish. Was I took a public speaking course. That really helped me. Now I don't have scripts anymore. There's a topic. People message me about something. When the community grows, it's very easy. You know what people
I
want you
noticed
to
that.
do videos on. So I
Yeah.
just go in front of the camera, hit record, I have a little webcam. I got a microphone. My videos are extremely easy, almost no editing to do. So that's why I'm able to pump out a lot of content. But yeah, I have the videos. I do one-on-one coaching sessions just on the weekend, which always sell out. It's
Yeah.
crazy. People want to, I talk to over 1,000 people, mostly Canadians, but also in the US, and a lot of people outside in Thailand, or people that want to kind of do what we did and leave the country and live off of their income. So I'm busy with that on the weekend. During the week, I do most of my filming, typically between like 12:30 and 2 in the afternoon. Um, and then I have those 2 digital products as well, which I worked on, which it started just as a tracker for me. That's how, I worked a lot with Excel in my job, a lot of reporting. So I was just trying myself to track all these ETFs, and eventually we developed kind of an Excel product, and we sell it now, and it comes with lifetime updates, and we're always updating it. And there's portfolio samples, whether it's for income, growth, or dividend. Like I talked about, there's 3 styles of investing, I feel, and I
Yeah.
don't discriminate. I think all 3 are great long term. With lists, and my wife kept adding to it. We kept adding to it, growing it, and so we have those 2 digital products as well, which we want to do at least one update per year.
Yeah.
So yeah, we're very busy. We want to start a podcast. Like I told you, we're very entrepreneurial. We love being entrepreneurial. It's just the way, because we didn't grow up. We grew up pretty poor. Like
Yeah.
we ate. We were able to eat and everything. But
Yeah.
both our parents, I mean, working class
Yeah.
immigrants, right? So
Yeah.
we don't come from money at all. So we always had that kind of ingrained, because even as a small child, I realized like money is the door's open. When you have that, your life is just better. You could do the things you want to do. That's I see money as freedom. I don't see it as like a greed thing. I see it
100%
as
same.
more freedom. More money equals more freedom. That's how I see
Yes.
it. Right?
I couldn't agree with you more. That's exactly how I see it. You mentioned your family's immigrants. I'm guessing they immigrated from Italy or from Europe,
Yeah.
right? What did your family think, both your families, when you guys were like, bye guys, we're going to
Everyone thought we were
Panama?
nuts.
No, when you go and move to Panama, what they think? When you're like, hey, I'm going to go to
Um,
Panama now and we're
Well,
going to move
they're,
here.
immigrant families, you know how they're very traditional, buy a
Yeah.
house and have a family. We just did the complete opposite. We did
Yeah.
the complete opposite of
Uh,
every expectation. That's just how we are. We don't, we don't go with the flow. We go against the grain, right? We go against the crowd. So at first, they were, well, really, they're hesitant or whatever to understand it. But then eventually they accepted, and then they saw that, okay, once
well,
they came to
obviously,
visit, then they see like this is such a great country. It's a pretty developed country in
yeah.
Central America,
Yeah.
where you have, obviously there's some adjustments, the weather, there's bugs, there's a lot of bugs here, but in Panama City, you look at the skyline, it's just it looks like Miami, New York. It's crazy. So it's a nice little, still well kept secret in my opinion. But we're here. It's going to be 3 years next week, I think, that
Yeah.
we're that we live full time in Panama. So
I,
eventually they accepted it. They came, they visited, and okay, everything's fine, So
I got a few more questions and I'll let you
sure,
go. We've been talking for a while, and it's more about Panama.
yeah,
Uh,
sure.
when in Panama, because you sold your property, are you renting there, or are you buying in Panama?
So what happened is we sold our condo, our paid off condo, and then we rented in Montreal, right?
Yeah.
And then we started thinking, well, let's snowbird because we hate the winter. So why should we stay? The YouTube channel is going. There's a little bit of revenue there. There's the portfolio income as well. Let's just get out of here for the winter. Let's go to Panama after seeing that other Canadian couple that went to Panama. So we like the beach. So we just Googled, the best beaches in Panama. It's Coronado, and it's a typical. It's probably one of the most popular, if not the most popular, expat community. So we went there. We stayed for 3.5 months. Made some friends. We found a place that we liked, owned by Canadians that we wanted to rent. We found a lawyer. Everything happened in those 3.5 months. It was great. When we decide we want to do something, we go fast. We go by feeling. As you probably know and learned already, time is the most valuable thing in the world. It's not
Yeah.
even close to being
Yeah.
money. So we stayed there 3.5 months. We fell in love with it, got our lawyer, started the process, went back home, sold everything. 3 months later, we were back in Panama living there full time.
Jesus,
the
that's
story.
awesome. That's perfect. That's awesome.
Yeah.
And then you probably just visit home every once in a while, right? For holidays or whatever.
Yeah, once in a while, sometimes I go back for business, like for Blossom events. I was one of the early. Now Blossom is big. It's really
They're everywhere.
huge, but I was one of the early influencers, if you will, to go with Brandon and the Blossom team and stuff. So sometimes I go back home for that.
Those guys are taking over. I had Marcos Mila on last week, and yeah, he's with Blossom as well. They're everywhere.
There's so many influencers on that now. A lot of mostly all young people that use TikTok, and I'm like the oldest guy there. I think I'm gonna be 40 this month, and I feel like an old fart already with all those kids. But it's really cool to see young people talk about the S&P 500, and it's literally the number one thing. When people come up to me and they have no clue about investing, nothing, zero knowledge, the first thing I tell them, look, you just never want to go wrong ever. You never want to lose money. S&P 500. That's what Warren Buffett tells everyone to buy for good reason, right? Whether it's VU or VFV or USCL or HYLD, it's the same crap, okay? S&P 500, start with that, go with that, and build on that. It's like one of the best things. But and we basically moved to Panama City like a week ago, by the way.
Yeah.
That's why I was late today for the call, which I apologize for. I'm usually never late.
Yeah, no worries.
But now I'm in the heart of the city. It's noisy, but hey, I could see the whole skyline right here. Actually, I'm looking at it, and it's pretty cool. Your dollar goes very far here. Like I actually live in it's the old Trump Tower. Actually, Marriott bought it. There's residents in here. It's pretty cool. There's restaurants. There's a 24. It's like living in a hotel. It's absolutely crazy. This in Montreal would probably be like, I don't know how much the rent would be, like 8,000 a month, like 6,000 at least.
Yeah.
Right. So here it's very, very affordable. It's not like Thailand or it's not super cheap because it's pretty developed.
Yeah. But it's cheaper than Montreal. It's like maybe a middle ground between Thailand and Montreal.
With the exchange rate, like you feel like you're not getting screwed. Like when we were in Canada, my wife and I, we have a saying, we always felt like we were getting gypped. Yeah. Everything was very, very high. The taxes, car registration, everything was always going up and up and up, and things were going up. Food, restaurants were crazy. Taxes were crazy. We couldn't go out to a nice restaurant without spending, if you get the wine and everything, without spending at least $200-$300.
Yeah.
Here, 100, you get the same thing, even better. 90, $100, no problem.
Yeah, I'm in Vancouver. Everything's ridiculous where I am in Vancouver.
Even crazier, I heard.
Yeah, it's just it's dumb. I'm thinking about like getting another property, but now I'm just like, do I even want to do that? Like, do I want
get
that's what I legitimately. I'm just like but I like allocate the money to buying another house and to turning it into like a rental property. But I'm like, it's not even going to appreciate. Like if I invest, it'll appreciate even better. Like it's a weird situation I'm in right now. About
did you ask yourself, is that investment going to beat the S&P 500?
Do you know why? But I actually, and here's something maybe homers need to understand. I stopped treating it now as a financial investment. So I have two kids. And I wanted to make sure they each had a house.
Mm.
that they can. So I was like, okay, I got a house, my daughter's got a house, and then I had a son. I'm like, I should probably get him a
Lucky
house.
them. Lucky them.
Yeah, right. So because I'm like, what's gonna happen in 30 years? They could be the richest kids on the planet. They can't buy a house because the market's gonna be so insane that no matter how well off they are, they can never buy in. It'll just be impossible. It's like, okay, well, if mom and dad don't handle it now, they won't have that, right? So we're trying to give them a head start in life as much because my parents were immigrants from India. They worked low paying jobs, but they gave me a head start by giving me a roof over my head, giving me a stable childhood, right? Just where I felt loved and giving me a roof
Yeah.
over my head. I felt I was fed. Huge head start, right? So that I could go and chase what I need to chase, right? My kids, I built up a certain level. Can they start where I start? I start above that. So I had to differentiate it. It's no longer a financial investment. It's a gotta take care of my kids type thing now. And I think that's how I justify it.
Yeah,
That's
it
the
makes
only way.
perfect sense, and it's
Yeah.
different for every situation, right? That
Yeah.
I usually tell people when it comes to even investing, there is no right or wrong. It's what's
Yeah.
right for you that you have to look at. Everyone's always looking for the best. Wait, is it the best time to get in? Is this the best? The best doesn't exist in investing. It's really what's the best for you. So every situation is different for sure.
Alrighty. Well, thanks for your time today. I really appreciate it. I think everyone learned a lot about covered call. And by the way, guys, make sure you check out the channel I mentioned before. Check out the first pin comment, the description. If you want to know anything about income oriented investing, this is the guy you need to be watching. Check out his channel. He has everything.
Yeah, we have a website too, passiveincomeinvesting.ca. That's where you could book the sessions, which are the June's one. The June ones are always sold out or are sold out already, but you could go on our website there. You could see the digital products, the channels there, the links and all that as well. Passiveincomeinvesting.ca.
All right, great. Thank you. Talk soon.
All right. Take care, man.